In this class, we're going to talk about revenue recognition, which is very important. And we're going to talk about allowances for bad debt and allowance for returns. Remember last class, we talked about the accounting equations. An important one we introduced was the balance sheet equation, which is assets equals liabilities plus stockholders' equity. We talked about some concepts of accrual accounting. We did some balance sheet equation entries, and in particular, we used the balance sheet equation to do Peters Company's financial statements, their balance sheet, their income statement, and their cash flow for the first year of Peters operations. In this class, we're going to finish up the Peters Company financial statements, and then we're going to introduce revenue recognition, how companies recognize revenue, and then we're going to introduce allowance accounting, how companies make estimates for the allowance for bad debt and allowance for returns. So remember from last time, this is where we ended up. So Peters has two performance measures we can look at for year one. The first is net income. They had net income of $3,000. The second is cash flow from operations. So they had cash flow from operations of $8,000. And then accruals is the difference between net income minus cash flow from operations. So accruals in their first year of operations were minus $5,000. Now we're going to do year two of the Peters Company. So in year two, remember in year one, they got advance payment from Julie's company of $6,000. This year, they're going to ship their remaining inventory to Julie's company, receive an additional $24,000. They're going to pay off the accounts payable for the inventory they purchased in year one. They're going to pay off their wages payable balance. They're going to get full payment on their outstanding accounts receivable. Fifth, they're going to incur and pay wages of $12,000. And then the final transaction we'll look at in review is that they'll pay a dividend of $9,000.